Okay, so let's start with the simplest thing we can with options. Okay, this is the BTC USD price right now. It's 63,205. Let's say you own uh, uh, one stock of this. So you've invested 63,205. This multiplied by this. Okay, and then you decide that, okay, I think I own the stock and I don't know what to do with it, but I think it's not going to really go up this week. So you could sell a call option, and I'll show you how you do that. So what does a call option, selling a call option do? It's known as a covered call, and a covered call basically will do this. So what do you know? You know the spot price for this is this. You know the strike price. Well, you've got to decide what the strike price should be. So let's say you think that it's not going to go much above, say, 2% higher in about 5 days' time. So you can you can figure out what 2% of this price is. It's 64,460. So let's approximate that to uh, let's approximate that to the nearest hundred. Uh, let's do it to the nearest 500, in fact. Yeah, 64,450. Okay, so maybe 64,450. So that's your strike price, and this is your spot price as well. That's the current price. And you're thinking in the next 5 days, do I think it's going to go to 64,469? Probably not. So the days to expiry is 5 days, which in so given that Bitcoin trades 365 days a year, this is the a fractional amount. What's the volatility of Bitcoin? Well, we don't really know that, so we can have a look at this and say, can we get some volatility? Now, volatility is kind of a very, very difficult thing to predict. But let's say we take the average of these, 56, 53, 64, so about 58. So let's say volatility is 58%. Okay. So now we know that also we know that no dividends are given by Bitcoin, and we know the interest rate is currently around about 4.75%. So we know this piece of information. So how much is an option going to be? Well, let's have a look. So you can use the function op bs call, and the easiest way to do it is use the video, and you say here's the current price, here's the strike price that we're going to use, the volatility is this, the risk-free rate is this, the dividend yield is 0, and the years to expiry, well, this is what we said, and it's 1,192. Okay, so if you so this is the call option. So basically, this is the premium you will receive. This is the premium you will receive if in 5 days the price of BTC finishes less than 64,450. Now let's try 64,500. Ah, look at that. Less likely chance of getting to there, and the premium changes very, very little. And why is this interesting? Well, let's say you on a weekly basis did this, and you typically found something which was 2% higher. I mean, do you think is going to go straight up 2% every week? No, it's probably not. You could sell that, and then there's 52 weeks in a year. So times the 52, you've made 61 grand. And bear in mind that in this example, Bitcoin has not changed in value. So if you owned Bitcoin for 63 grand, you would, and say the price moved up and down, but on the fifth day every week, nothing changed. Well, yeah, it was less than this 2% move. Then on average, you would make, say, 61 grand on top. So your actual holding at the end of the year would be this plus this. And that's your simplest trade that you could make. A simple selling a call option. So this is known as selling a call option or a covered call. Now, why is this covered? What does covered mean? Well, covered means that you own the stock. And that's really, really important because if, let's say, you didn't own the stock and this happened, um, here's the problem. So you would end up with um, uh, on, let's say the price ended up higher than 64,500. Let's say it ended up at 65,000, let's say, after 2 days, and you didn't own the stock, you would just had the option. You now need to go buy Bitcoin for whatever price it is, maybe even 66,000, 67,000, 68,000. Who knows where it is, right? We don't know. It's just somewhat higher than the strike. You would now need to purchase Bitcoin at 68,000 and give it to the person who owned that option. I.e., remember, you sold this option to someone else. That person is expecting to receive Bitcoin at 65, and he is going to sell it at whatever the price is right now, 68. You obviously now have a liability to purchase 68 grand worth of Bitcoin and sell it to him at 6,500. So that is obviously not a great situation to be in, and which is why you must always own the underlying, and that's why it's called a covered. Because if it's covered, yes, you still owe the person at 65,000. The price is 68, but you own the stock already. You presumably bought it at maybe 61,000 or whatever, or maybe even 55,000 or 50,000, and you can now give that person the 65,000 the stock for 65,000. You still keep that premium, so it's reduced your costs. So effectively, instead of losing 68 minus 65, what you've actually lost is 68 minus that minus that. Only 1,820. So your losses are lower. They're only 1,826 in the bad scenario. And in a positive scenario, i.e., the price ends up below 64,500, you've basically pocketed that money and nothing else has happened. You just put that in your account and you said thank you very much and you've moved on. So that's your simplest trade that you can do with options, is selling. Now, you can do the same thing going the other way. Let's say you're short BTC USD, in which case you have sold 63. Let's use the same price, $63,000 worth of options, and instead of doing a call option, you do a put. You sell a put option instead. Remember, these are all sells, so let's just make this very clear. Sell, sell. But this time you're short. Now this does it in exactly the same way. You're selling a put option, i.e., you expect the price not to go down. Let's say 2%. So this is times 0.98. You expect in this example for it to stay above 61,985. Let's make that into, say, 61,500. You expect it not to go below that. And in the same way, you can call the option pricing formula OPBS put, and you can basically say same thing. The current price is this, strike price is this, volatility we're assuming is the same, the risk-free rate is this, the dividend yield is 0, and the years to expiry same, 5 days time. So in 5 days you could make 956. The number is slightly different, but obviously this price is different as well. But you'll make, basically, if it ends up, if it starts going up, Bitcoin does tend to do that quite a lot, then you will make $900 in your bank account by the end of the week. So every 5 days you're making this sort of number, and as long as it doesn't end up. And remember, just because it goes down beyond this limit, say in 3 days' time it's at 60,500, you can sit around and wait and hope that by Friday it's going to be 61, say, um, 61,501 basically, and then you'll still be okay. But here's the thing. Let's say this does go down and it goes down by $956. Say it ends up at 60,544 and you're thinking, oh my God, I've made a loss. But you haven't, because you've picked up this $956 on top of this. So you're protected down to 60544 and equally on the upside. So in so this adds this put option, or in this example the call option, adds a bit of protection, which basically says to you that actually I don't actually have to get worry at 61500. You know, it might be annoying, but I don't actually have to worry because I've actually banked an extra $956 of buffer in my bank account. So it could actually go down to 6544 before I lose, and that's a bigger number. That's um, 4.2%. So that's almost doubled your buffer. So, you know, you were thinking, oh, 2% is kind of like a pretty big move. This is if just by selling the option after you've decided on that 2%, you've actually increased your buffer to 4%. Now, a 58% stock, a stock that's 58% volatility, if we square root that by 365, we get uh, we get an average daily move of 3%. So a 3% move on is basically 1,918. So that's how much it moves up and down, up and down, up and down. Now, obviously, it doesn't move in a straight line either way. So you can imagine that it could end up at either back to where it started, it could move in one particular direction, and so on. So there, you don't have to worry about that at all. So there's a number of different ways to play this, but this is kind of the simplest way you can play options. Just you own the stock or you short the stock, never mind which way, and you sell an option, a call option if you're long and a put option if you're short, and you make the premium. And you just keep making the premium weekly, weekly, weekly. And yes, sometimes you will lose. Here's your and let's say in this example the price does shoot up. If it does shoot up, okay, you've still got 5 days before you've got to worry. And and remember, even if it does shoot up, you can sell another call option, so which will reduce the losses. So this in this example, the loss was only 1,800 because of this buffer that you had. You could, as soon as you see it getting to, say, I don't know, 67,000, maybe you sell another option, which basically reduces it by another $1,100 or something like that. So that reduces your losses to basically $726, and you keep that premium, because what's the chance of it moving up twice, two times 4%, 8%, an 8% rise in Bitcoin in 5 days? Pretty unlikely. You'd have to see a pretty big change in circumstances to see that. So you've basically banked yourself the 1,700 plus the seven plus another 1,100, 2,200, which is basically buffering your losses, and it's basically giving you a pretty big headroom in terms of which direction the underlying is going to go. Similarly for the put option on the downside. That's probably the simplest trade that you could do, and it's pretty simple. Okay, let's think of the next. So that's your covered call, covered put, or protective put, as it's called, selling. The next thing is, let's say you don't know which side your the stocks will go. So let's take the same thing again, 63,205, and let's buy a call and a put. So we're gonna to buy this. Let's just copy this thing. Let's make these fixed. So we're buying that. Now the change is going to be let's buy this exactly instead of having a strike at 64,500, let's buy it exactly at 63,205. So the price will be slightly different. It's a bit more expensive, 1735. But this time we've bought the call option. Um, so we have the right to buy BTC USD at 63,205 no matter what happens. Similarly, you could buy the put option. So let's do that in the same way. Let's just copy this, and this time round we change to a put. We keep everything exactly the same, and we get see. So now we've paid. So we're down this plus this. We're down $3,400. Now what's happened is that if BTC USD were to rise, then the call option would gain value and the put option would lose value. So let's have a look. So in 5 days time, so in let's put this in 5 days time. Let's just see, 1, 2, 3, 4, 5, and it's really good to plot this sort of stuff. In 5 days time, everything stays the same except this number, instead of being that, is going to be one less. So let's change this to being, so this is 4 days time, 3 days time, 2 days time, 1 days time, 0 days time. So we can basically do this correctly. So this would be time to expiry, which is this one. So this is this divided by 365. So it's worth that, it's worth that, it's worth that, it's worth that, it's worth that. So it's worth 0 on the day. So on the last day it's worth 0. And the same with the put. Let's change that. So with 5 days to expiry it's worth this. And with 4 days to expiry it's worth this. Back to 0 again. Okay, so what can you see here? Let's make this 0.0001 just to give it a price so you can see something. This is in the last minute. So what you can see is that this thing over the next few days is going to decay. So it's going to lose more and more value. However, if the price of Bitcoin goes up, let's say on the fourth day, it's gone up to, let's say it's gone up 5%, or let's make it 3%. It's gone up 3%. Let's say it starts streaking in one direction. Okay, let's say this is what happens, and it goes. You're really confident. You think it's going to go up 3% every day. It's going to have a streak, right? So what is the call option worth? Well, the call option, the the spot price has now changed to this. So it's now worth that, and that, and that, and that, and that. Oops, there's no spot there. And yeah, so let's get rid of that. And the put option is worth, change that, and we make it this. Oops, sorry. The put option is worth this. It's almost worth nothing. Now, so why is this good? Well, look, how much have you made how much have you made on Bitcoin? Well, after 5 days on Bitcoin, you've made 7,000. This one minus this, you made 7,900. Thinking, okay, that's pretty good. But you've missed something. On the call option, you've made 6,209, and on the put option, you've lost. Remember, you've lost um, this whole thing because it's now worth 0 or 0.2 cents basically. So this is a negative. So now you've made on your stock, you've lost on your stock, you've done this. Let's do a sum. You've made this on your stock, this on your call option, this on your put option. 12,000. So if you just held the stock, you would have made about 7.9 grand. Whereas with the call and the put, both sides, you've made 12,452. Now, why is this a better trade than just holding the stock? Well, let's go the other way. Let's say the price fell instead. So let's do the same example. It starts at 63205 and 63205. And remember, you've not changed this. You still hold this call and the put. You don't know which direction it's going to go. So you've just paid this straight away. And a day later, it's going to move down 3%, right? And then your call and put options are now worth what? Well, the instead of I33 being, it should be I33 there and I33 there. Yep. So your call is worth this, your put is worth this. Exactly the same scenario. Now your call is worth nothing, but now what have you made? Well, you've lost money on the stock, so you've made uh, this minus this. You've lost 7 grand on the stock, but you've made 5,000 on that, and you've lost uh, 700 on that. So that plus this minus 2,400. You've lost 2,400. So instead of losing 7 grand, you've only lost 2.5 grand. So it is never going to be. Oh, actually no, we've actually made more than this because I forgot to use the first day. Yeah. So you made that on the stock. You've made, yeah. So that's the put. You've made a put, and you've lost. Yeah, you lost 3.5 grand on this. So basically, instead of losing 7 grand, you've actually made money on the put, which has basically offset that, and you've lost a lot less. Now you could have bought two puts, which would have doubled that, or you could have chosen a different strike, whatever you want to do, and that's the whole point. You could play around with this however you want and get different types of scenarios. So if you'd bought two of these, you would have made a profit of 1019 in this case. So you could have bought two puts and one call, which basically would have protected you on both sides. If the price goes up, you make this much, and if the price goes down, you kind of lose. You still make money. So on both directions, you've made money. Now, is this a better trade? Depends. If you don't have any clue which way it's going to go, or you don't have any particular preferences, then this could be a better trade. If you're going to go down, if you think that, nah, I don't know, I think I just want to hold the stock and I have a directional view, selling the call option might be better. Each of them have different risks because, potentially you could lose something. In this example, in this one, you might lose something or gain something as well. But you've basically, you know, you've made 56% more. You made 56% more money doing this trade than if you just held the stock. And in this example, you've lost a lot less as well. Okay, I did do this with two, but let's do it with one again. Instead of losing 7,000, you've lost 3,000. You've only lost 48% of what you would have done. So you've gone up. This particular trade has an upside bias, uh, and therefore you make more on the upside than you lose on the downside, which is great. It's like a very simple trade to kind of give you what you want. So yeah, so these are the two simplest trades that you can do with options. But as you start to add more calls and puts, you can create all sorts of weird and wonderful shapes. And it's definitely worth plotting them so you can see what it looks like. You can see this kind of shape, or the put going down like this, or maybe you plot both and you can see like if we do the labels, call and put over time. And you can see the put falls in value and the call goes up in value uh, over time as the price goes up. So yeah, it's kind of interesting to view it like that. So yeah, so there's like there's two dimensions in options. There is the um, price dimension, which is how much the underlying is moving, and that will increase or decrease the value of your option. And then there's the time, which is basically each day. So this is what this axis is. It's after 1 day, after 2 days, after 3 days, and 4 days, and 5 days. You know what the thing is worth. And you can play with this in very, very different ways and come up with all sorts of interesting shapes. I mean, ideally what you want is a straight line, which says no matter what happens in time, no matter what happens in price, no matter what happens in anything, you always make money. Now that's impossible to achieve, so there's always some kind of curve. But you can play around with this to try and optimize your way out of this. Good.